Hello and welcome to CIMA F1 Financial Operations. We are in chapter 6 and we are covering within this video IAS 38 intangible assets, which starts at page 28 of your chapter of Express Notes. This chapter has been split into its two parts, IAS 16, a previous video, which is the tangible non-current assets, and IAS 38, we cover now the intangible assets. And really there are three major categories we'll be looking at when we talk about intangible assets: R&D, research and development, goodwill, and any other intangible non-current assets. That's how the standard approaches the non-current assets. Of course, you would have to think, like we said earlier for IAS 16, of the definition of the asset, the recognition criteria, and so on. Now let's talk about initial recognition for research and development. If you take the research costs, you will always write those costs off. Because the outcome, remember in recognition criteria, the outcome is not probable. You are researching different, let's say, drugs, like in medicines, and at the research stage, you are not sure of the outcome. Because of that, because you don't have a probable outflow of resources, you will never recognize research cost in the statement of comprehensive income. So you write them off immediately. When it comes to development costs, well, it's a bit different. You can capitalize development costs as an intangible non-current asset if reasonably certain of future benefits. So how do we demonstrate this reasonably certain future benefits? Well, there's a lovely mnemonic, which is an abbreviation of the initials of each element you would have to consider to see if by meeting those particular criteria, you can capitalize development costs or not. And that abbreviation is red pie. How lovely is that? You will see this red pie, and in fact, I'm going to take you straight away there. If you go to the very next page, and we shuffle back in a minute, at the middle of the very next page, what is this red pie about? You see here is the red pie. Well, you have to demonstrate that this development expenditure has been incurred, and you will almost certainly have a product and you will generate revenues. And obviously, if there are future economic benefits, then you can capitalize the non-current asset, and then via amortization, you will create that matching between the revenue it generates and the expenditure related to its development. Now, the spirit of the standard says that in order to capitalize, you have to make sure that the company has enough resources to complete the project. So let's say you are in the pharmaceutical company. Do you have enough resources in terms of financials, people, and so on to finish it off? Or you're just stopping here? You invested millions and millions of dollars, but that's it. You have no more, and you will not make this product really sellable in the hands of the consumers, of the beneficiaries. What about ability to complete? Are we ready to finish it off? Do we still have the expertise? All these elements would be more like a business plan, isn't it, towards the completion and the sale of this particular, drug in our case, or medicine. Technically feasible. What do we mean by technically feasible? Well, what were we aiming with? What have we researched and developed? Well, let's say we developed a drug that cures cancer. And is that really working? Do we have some proofs of that, some tests and so on? And of course, that would be added up to the plan. Probable economic benefits. Is that expected to be profitable? In other words, do we think people need a cure for cancer? And how is it going to reach the consumer? How are we going to make the money? Where are we going to distribute it? And so on. Is that an intention to complete the project? Yes, it should be an intention, but again, a forecast of the life of this particular drug, at least on the time frame of the license, which is most important when such drugs would generate revenues, you would need to prepare and complete the picture of the red pie. Don't you tell in the exam red pie? This is just to help you remember resources, ability to complete, technical feasibility, probable economic benefits, and I from intent to complete, and finally E from expenditure on the project can be separately recorded, which usually is not a challenge, and you'd have to keep track of all the development costs incurred during the life of the development process. Okay, so as you can see, there are some quite strict criteria of recognition. So if I take you, sorry, I took you a bit too back in our notes. If I take you back here, right, just here, you have the criteria of recognition, the red pie, and you say, yes, if we meet those criteria, the development costs can be capitalized. Let's carry on down the line on a column basis. Okay, so ignore goodwill and other intangible assets, and let's see initial valuation. Basically, it's all the costs incurred for the development costs for the development phase, and you can include any transaction costs that may occur. What about amortization period? Obviously, for, like I said, if you take the drugs industry, you have an expected useful life, and like any useful life in IAS 16 in your tangible non-current assets, you have to revise that periodically, annually if possible. And of course, you would have the cost period. Remember the matching accrual principle, the cost that would match the pattern of revenues over the useful life of the asset. All this excitement, all I wanted is to go to the very next part. Upward revaluation possible? Well, no, and there would be a specific situation only in case there was an impairment loss previously recognized that you reverse. You could argue get an effect of a revaluation. Impairment loss recognition? Well, recognize impairment loss exactly as per IAS 36, and we will cover that in the very next chapter. Reversal of impairment losses, yes, it's possible if you have to reverse. These are almost not often occurring, really, but just to have an awareness. And allowed alternative presentation, not at all. You just have to get your development costs, see if you meet criteria, and if you meet criteria and you capitalize, you'll have to think of amortization periods, start amortizing, and so on. So unlikely to have upwards revaluations, really, impairments, losses as such. Impairment losses, reversals rather. Most likely you would have amortization and maybe some impairment losses, because let's say something happened and you overestimated the potential of sale, and there is a competitor out there who just damages the business, the product you created with different expectations, so you may have to impair a bit these development costs. Okay, let's have a look at goodwill. There are more types of goodwill. You have, and I'm going to highlight here, internally generated goodwill, and you have purchased goodwill. And remember, when it's purchased goodwill, it can be positive, but it can also be negative goodwill. So if you're looking at internally generated goodwill, imagine your company has a fantastic goodwill, but all generated inherently. You haven't acquired it. Think your Coca-Cola. Does Coca-Cola have an internally generated goodwill? Absolutely phenomenal. Probably is one of the most expensive brands in the world. Well, that goodwill, which is internally generated, you'll never ever see it on the statement of financial position of Coca-Cola. Why not? Well, because it's hard to put a value on it. It's hard to measure, to put a monetary value. You can, but it would be a huge approximation. It would be so unreliable, and it would mislead the stakeholders. So internally generated goodwill, never recognized in the financial statements. What about purchased goodwill? Well, we'll hear that, and we'll hear about that more when we talk about consolidation. And of course, we'll be looking at identifying the goodwill purchased and calculating it and accounting for it in the financial statements. And this purchased goodwill, of course, will be recognized as an asset. What happens if we purchase a company, let's say, but we pay less than it's worth, and then we generate a negative goodwill? Negative goodwill will have to be written off immediately as a credit to profit. So this being said, goodwill, remember, is more types, and what do we do with it? How is the initial valuation for goodwill? Well, in simple terms, because like I said, on consolidation we'll speak more about goodwill on consolidation chapters, you have to think as goodwill being the difference between the fair value of consideration paid, which is pretty much the investment, the amount you pay for acquiring, let's say, a business, less the fair value of net assets acquired less how much it's worth that particular business. So the difference between them two gives you goodwill. And remember, transaction costs that could arise on that exercise of acquisition are written off immediately against the profit. Or loss, indeed, you could have loss. Okay, when it comes to amortization, what do we do with goodwill? Remember, unlike other intangibles, goodwill is not amortized. But what you have to do is always make sure you can have this test for impairment every single year. All right. So these would be the key points I wanted to highlight on the goodwill. You can read a bit more about it, and as I said, goodwill will be touched upon quite in a bit of detail on consolidation, and it is there that you will see that you have an allowed alternative presentation for goodwill that can elect to present a gross or a proportionate goodwill value. So you will have to do or be aware of two calculations of goodwill because you are allowed two alternative presentations. Okay, so three categories we said of non-current assets: research and development, goodwill, and other intangible non-current assets. What do we have here? Any other intangible non-current asset except for goodwill and research and development. So you can have here a patent, for instance. But what is the key element or key test to look at is control. Do we have control over that particular asset? Because sometimes it's quite challenging. For instance, I did use and refer to this example in one of the previous videos. If you think of a service company, the most valuable asset of that service company must be the people. And the reason why we don't recognize people, because they would be pretty intangible in assets to us, wouldn't they? Is because we can't control them. No matter what arrangement or agreements you're making with these individuals, you cannot control them. Therefore, control is a challenge when you talk about the intangible non-current assets. In terms of initial valuation, it's exactly the same discussion as research and development. We said that. What happens with amortization? Well, again, all these intangible non-current assets have their expected life, may have a residual value, pretty much like tangible non-current assets, and you could use different methods of amortization, not necessarily straight line. And they do have a finite life, as we said, unlike goodwill, for instance. Can you have upwards revaluation? Yes, you can, but remember, so imagine you have a patent. Does it exist an active market to help you do the revaluation? That is a challenge in the previous two categories because there's no such active market for research and for development costs, and there is no such active market for a specific goodwill because that's pretty unique to each transaction. Impairment loss recognition. Recognize impairment exactly as per IAS 36, and as I said, for research and development, we'll look at impairment impact into a specific standard next chapter, next video. Alright, this being said, you have the three categories, and a lot of what we said here, you have a bit more detail as you come along. Remember, the accounting for negative goodwill is very important. The negative goodwill is a credit to the income statement. What else we have? Well, now you can maybe remember, if you had a chance to recap IAS 16 for tangible non-current assets, see what's different. For the write-off periods, well, for intangible assets with a definite life, remember patents was one of the examples I also mentioned. It's very similar to IAS 16, isn't it, in terms of how, in terms of write-off. However, in this standard, you have intangible assets with indefinite life, as we saw goodwill, and then you have the impairment test. You don't have amortization. All right, in terms of impairments, remember the standard, and we'll talk about IAS 36 just very soon in the next video. In terms of revaluation, well, you've seen there are certain situations it's quite different, isn't it, than IAS 16, which allows a choice for evaluation. Here in IAS 38 it's a bit more complex, the situation, and you have to prove if you want to revalue your intangible assets, that there is an active market in respect to that particular intangible asset you want to revalue. And the items traded in the market are homogeneous. Willing buyers and sellers can normally be found at any time. So there is really active and transparent, and prices are available to the market. So this pretty much describes a transparent, efficient market from where you can take the benchmark against which you're calculating a revaluation. Okay, I think that's the end of the chapter. These are the highlights, of course, of IAS 38, and don't forget, you need to practice questions and all these highlights just to apply in a question. IAS 38 will involve some professional judgment, so be ready to maybe know the criteria for research and development, know the background for goodwill, it's the standard that covers it, and ultimately any other intangible assets in terms of accounting treatment, amortization, revaluation, and so on. Thank you so much for paying attention. Best of luck with prepping, and look forward to being in touch with you on the next video. Good luck!